Welcome to the Skinny on Wall Street with Kristen
and Jen.
So just in time for our favorite HBO Max show, Industry, to come back, it looks like HBO is getting bought by Netflix. And so this is this is a really cool M&A case study. We love breaking down these deals. There's so much in here. There's spin-offs, there's costless collars. Well, I assume it's costless. There's regulation. Will it happen? Won't that happen? Smear campaigns.
I feel like this is Stefan from SNL being like, this deal has it all. Collars, spin-offs, smear campaigns. So I'm so excited for the drama. We're excited to be recording Industry for you. So we're going to get back on track with that. Hopefully Monday we'll be recording. I should be done filming everything for the course today, and then I'll just be in editing mode. But yeah, Kristen, why don't you kick us off?
Netflix has agreed to buy Warner Brothers Discovery's content and streaming studio business. So specifically that's HBO, HBO Max, Warner Brothers, film studios, blah, blah, blah. But they are not buying their cable assets. So I'm going to get to that in a second. So the deal is priced at $27.75 a share, which is made up of a combination of cash and stock. So if you are a shareholder in Warner Brothers right now, you would receive $23.25 of cash, and you would get $4.50 worth of Netflix stock. Okay. So a couple of things about this. Number one, it's called like the offer value, because in like the corporate finance world, you have equity value and enterprise value. The equity value is what the equity is worth, and the enterprise value is what the firm as a whole is worth.
But we need to cover this again on this podcast, guys. Like, you have not been listening.
Yeah, but it's not so much that. It's more just that, like, when we're talking about what you are offering to buy the equity for, that's where there is like a premium to where the company is, or the equity is worth on a standalone basis. So they are offering $72 billion, which is more than what the equity is worth by itself. So $72 billion as an offer value, and transaction value is $82.7 billion. But okay, a couple things. Number one, the $4.50 that they're getting in Netflix stock. So you think about it, right? You are a shareholder. You are not only getting that cash, you are going to now be a future Netflix shareholder, and you're going to have $4.50 of stock of Netflix to participate in that upside. The problem is, like, the deal is not going to close for, call it, a year. I mean, first of all, it has to actually get through the regulatory scrutiny. And I guess
I was going to say, like, aren't there concerns from like a monopoly standpoint?
Yeah. 100%. And actually, it's like taking a step back. We're going to talk about like the bidding war, because this wasn't just like, oh, out of nowhere, Netflix made this announcement. No. Warner Brothers has been for sale, and you had three players who were bidding on them. So you had Paramount, our friends who, Paramount Skydance. They were basically bidding to buy the entire company. So remember how I said Warner Brothers has both like the streaming assets, the studio, and the cable assets, the CNN?
I've never gone onto a Warner Brothers streaming app. What's it called?
No. I don't think it is. Like, they basically own a whole bunch of different assets. Like, if you think about it, like, they're just the parent company assets? And they own a bunch of assets.
Like, I know there's the Discovery Channel network, but like...
Well, they own...
Is there a Discovery app? Like, can I go watch Shark Week on an individual streaming app? Is that how it works?
Well, it's less about that. It's more that if you think about what they own HBO, HBO Max, Warner Brothers. They have the TV studios. They have the video libraries. So, like, they have a bunch of different assets.
It's also
CNN.
Like the Harry Potter movies, right? Like, are part and parcel of this, right? Anything that has that giant WB at the beginning, I assume, is like part of this asset library.
Well, I think it's more complicated than that. And again, I am not, there is an amazing podcast called The Town that I always listen to, because I feel like the two things that we need to be up to date on in what we do is kind of like what's going on in streaming and the wars there. So as a non-expert, I listen to, I think it's Matt Bellany with The Town, who does a bunch of deep dives into like when Paramount was going through. I wanted to become as well-versed in a lot of the nuances of these types of transactions as I could. So I listened to that a lot. And then obviously like the AI stuff. But this is so much more complicated than just what is the streaming. I mean, they own a ton of assets. And I think that's the whole thing. They have the studio, right? They have the film library. They have all the shows under HBO Max, blah, blah, blah. So, and then they have CNN, TNT, TBS, like they have a whole bunch of other assets. Yeah. I mean, like they basically own a bunch of different things. And so when we're talking about Paramount Skydance buying potentially a whole company, they would get everything versus you had two other buyers. So you had Comcast and Netflix, who were both bidding just to buy the studio streaming side, so like the HBO and again, the studio, not the cable assets, the CNN, the TBS, et cetera.
Oh,
So
got it.
what's going to happen, because ultimately in this bidding war, they submitted initial bids, they then submitted final bids, like the lawyers and the bankers and all that were like kind of drawing up how this thing was going to be structured. And so the deal is such that Warner Brothers is going to do a spinoff. So the way to think about this is if you were an owner of Warner Brothers historically. So pretend before this deal was announced, you as a Warner Brothers shareholder, you had shares in something that was worth $23. And again, they owned HBO and CNN. Let's make it very simple. They own two assets, right? The cable is CNN and HBO is the other one. So $23. What happens with a spinoff is that the company basically now creates a new entity, a new public entity. We'll call them CNN. And you, as now the shareholder, you own CNN for say $4 and you own HBO for $20. So you still have the same amount of value. It's just that they've been split apart. And so what's going to happen is that now you have Netflix coming along and buying like that $20 HBO portion only. And you still have the ownership in that now separate company that's going to be off in the markets just trading like on its own, la-di-da-di-da, but it's spun off. So the acquisition is just for the streaming assets and the studios, not for the cable network. And Matt Bellany in The Town, I was listening to this before we hopped on, just again, to get more of the backstory, because so much with M&A is like the story. And it sounds like one of the things that Netflix had to do, well, there's the whole regulatory thing, because in the background, like if you are Warner Brothers, part of what you want to make sure happens is like when you go with one of these people that like it actually is able to go through the government. So there was this almost behind the scene campaign of Trump loves like Larry Ellison. So of course Paramount Skydance would get through, and like he hates whoever else, so that wouldn't happen. Or it's like, well, internationally that's a problem. So there was like all these little almost like smear campaigns going on behind the scene to try to also like influence who was going to win. It wasn't just about who had the best price and stuff. But anyway, the TLDR here is that first of all, they are doing the spinoff. I think it's like Q3 of 2026 is when this deal would be expected to close. You would have Netflix then own HBO. Really, all of those assets. And the other point was that I guess the thing that Warner Brothers was potentially worried about as well is they view Netflix as like the death of the theater business, because what Netflix wants to do is like have all these premium movies that you can just watch on your couch at home and not go to the theater. And so they wanted to make sure that if this transaction goes through, that like Netflix is not going to kill the theater business and like not gonna, not allow their movies to actually go to theaters. That was like a whole other thing that I guess they had to almost like assure the management of Warner Brothers that they would do. Because again, it's Zaslav. It's like Warner Brothers who ultimately makes the decision about which bid do we want to accept.
Yeah.
Yes, they're looking at what the offers are, but also that other piece is part of it too. All right. So then the second thing, like I said, is that when we're talking about any kind of M&A deal, when there's a stock component, there is uncertainty. There is uncertainty for the buyer and the seller. Now, let's talk about what the buyers and the sellers each respectively want. If you're a seller, what do you care about? You care about getting a certain amount of value. You've been promised that you're going to be getting $27.75. You want to make sure that you get that, even if the share price of Netflix drops. So the main thing that they care about is getting that total value. But on the flip side, the buyer, they don't care so much about the total value. I mean, they do, but if their share price goes down, what they're focused on is how many shares am I giving to the seller in order to make this deal work? Because they're basically going to have to issue equity, and the more equity that they have to issue, the more dilutive it's going to be, the less this deal looks good from sort of an affordability standpoint. We talk about this concept of accretion, whatever, but TLDR, the buyer cares about how many shares they're giving away. The seller cares about the value. And so the way that you can protect both of these parties is by doing something called a collar. And the way that they've structured this in this Netflix transaction is, if you think about a graph, if Netflix share price 15 days prior to the closing of this deal, if their what's called volume weighted average price, so VWAP, is between 97 and 119, then Netflix promises to give the shareholders of Warner Brothers $4.50. And the exchange ratio, meaning how many shares you are getting of Netflix, is going to be adjusted in that band to come up with a fixed value of $4.50. However, if you go in either direction, above or below, Then what happens is if the share price is under $97, then the number, you're going to get a fixed exchange ratio, which limits how much damage can be done to the buyer. So they're not going to have to give away more than basically an exchange ratio of 0.046. So that's how many shares they would have to give to Warner Brothers. But above a certain share price, it's also fixed. So it would get fixed at 0.376. So in either direction. So that's something that's pretty typical in M&A transactions whenever you have stock-based consideration because of that uncertainty in between when the deal is agreed upon and when the deal actually closes. So does that make sense? Did I explain that right as you were listening to it?
It totally makes sense, I guess, intuitively, not being an equities person, which sounds funny because like I'm sure this is much easier for people to understand than rates. But in the rates world, the way you structure something around the risk associated with issuing debt to finance a new deal, your risk as an issuer is that in the future, rates go up and it will increase your cost to issue. Therefore, you can structure something called a costless swaption collar, where TLDR, you buy a put, right? You buy a payer swaption funded by selling a receiver swaption. And you structure that at zero cost. So the two things perfectly offset. And what that does is that limits your risk to rates rising, and you forego the benefit potentially of rates rallying, which would decrease your cost of issuance, but you're issuing bonds at lower rates. So you're happy. You've given up some of that upside. And I'm just curious, if you're structuring it in this way, my understanding is that the risk is that the share price drops. So you're actually buying a put funded by a call, correct?
I assume so. It's funny. My brain very much understands call spreads because I worked with those all the time in the world. Yeah, because it's the structure that I worked on. So I believe it is the put and the call again, but again, this is not my area of expertise. I'm just like, this is kind of how we think about the payout profile. And this is how we're thinking about wanting to protect these two aspects of it. And to your point, I do believe it is likely costless. It may not be, but the whole idea is you're protecting against the movement in the share price for both the potential benefit and risks of the buyer and the seller.
And fun fact for our listeners who are aspiring traders, a non-costless collar is typically called a risk reversal, where you are buying an option in one direction, funded by selling another in another direction, but they do not equally offset.
Yeah. So anyway, it is very interesting that they are potentially going to be going through with this transaction. The only other thing that I was trying to look into was like, what is the respective theoretical valuations between the cable assets and the streaming? Because I was like, what's the premium? But it's hard to like think about a premium because ultimately what's being bought is just one piece. Now, what's interesting is that they are offering, I think it's like 15% over where Discovery was trading or Warner Brothers was trading. They were trading at like 23 or 24. And they're offering like 27. That's a very low premium. It's like 10 to 15%. But I believe it is just because like that is not factoring in. I don't think they're grossing up to assume for like, again, losing out on that other asset, on the cable assets. Now, you also might see sometimes like a lower premium because we know that this transaction was going on. Like we know there was a bidding war. So oftentimes you'll have a premium priced in, but I believe more of it is because like they're just not buying everything. So like where the company trades reflects all of the assets and they're only buying a piece of it. So I think that's what's going on. Sometimes you will gross stuff up, but again, I don't think that's what they're doing. So yeah.
Do you have any view on the likelihood of the deal going through?
None, but I feel like, this is not meant to be political. I think if you compliment Trump enough, I think the deal goes through. Like, I mean, that's my cynical take. So I feel like Netflix is probably going to go on a campaign to kiss up to the administration to get this deal to go through. But yeah, I think that's why people thought that the Paramount merger was potentially a higher chance thing because again, of Trump's close relationship with Larry Ellison, but Netflix was the one that was ultimately chosen and the winner. So yeah.
My only concern is preserving the quality of HBO content because I do think
yes.
HBO is like the best TV out there. And Netflix, by comparison, just doesn't have the same level of shows. Like it really just doesn't. And I watched the first 4 episodes or whatever of Stranger Things season 5. And I'm really just watching it because I know that it's all going to be spoiled by memes. So I like wanted to watch it so that it wouldn't be ruined for me and I could like enjoy it a little bit. And I mean, but like their Hallmark hard-hitting like best flagship shows I think are still so inferior to the product
Yeah.
on HBO, where
Yeah.
Industry, what we love, isn't
Mhm.
even like one of their canonical. I was trying to, we're going to be recording on Monday, I think season 3, episode 3. And I was trying to look it up in the HBO app, and I was just like IN in my search. And it like, even HBO throws it down there at like the bottom of the search results. Like, do you want Inception? That was a good movie. Are you sure you don't want
Yeah.
Inception? I'm like, I don't. I would like Industry, your great series that I think is, great in so many ways. And they're like, it's not that good. And I think it's still better than like 99.9% of the content on Netflix. So
Yeah.
I just hope that HBO keeps doing what they're doing, and Netflix be Netflix, like have your content. But I, as like a consumer of content, am very precious about the quality on HBO relative to the unspeakably bad 3-Body Problem adaptation on Netflix, which I like can't even talk about without wanting to cry. So,
well,
I
think
big with this business, I'll retire and make my own adaptation.
Ooh, I would pay a lot of money to see that. That would be amazing.
Our next journey together, Kristen, is making big budget sci-fi films together.
Oh man. Yeah. Well, I have to finish The Dark Forest. I started that and oh my gosh, I haven't even like continued. So that is book 2 in the 3-Body Problem. And what were we talking about recently where I was
I used to bring it into everyday conversation no matter what, which is what I just did here.
Well, no. So what happened is Jen was like trying to describe The Dark Forest, which I guess is this, she's like, this is like the best book in the series. She's like, but it begins with this like really random, like rambling story that is totally unnecessary to the plot. And I was like, the good news with Industry, because we have 6 episodes that we have to do left. I was like, one of those episodes literally is that same thing. So hopefully we'll just be able to like, plop it in with another episode.
Whatever it is, season 3, episode 6 happened. Next.
Yeah. It's like, this is totally irrelevant. And like, sure, it leads to one other little nuance that we see, but like, it's so not like it could have been like a scene. All right, Jen. So was there anything else that we want to get into?
No, this was awesome. I cannot wait to get back into recording our breakdowns of Industry. And we have some amazing interviews coming up for you guys in addition to this content. So we'll be rolling those out as we get compliance approval. Sometimes these things are beyond our control. So with that, wishing you guys a happy wintry weekend, and we'll talk soon.
Well, one quick thing, just really fast. We post the video versions of this on YouTube. And by the way, I just spent way too many hours last night trying to get the video uploaded on Spotify too. So you can watch the video version of this on both YouTube now and Spotify. So with that, thank you guys so much, and we'll see you next week.
Bye.